Hi, this is Ron Janish, and this video is about portfolio and risk management made easy, dedicated to Tim, who took my course, about 25 years ago. That's how he learned the techniques. He lives in Chicago, and he focuses on Forex these days. He used to trade all kinds of commodities, used to be a commodity trading advisor. And I could never really understand why he thought this was such an incredibly vital an important area because Andrew's never really pushed on it very much at all. So we're going to go into it now, and you'll see it's really easy. So how difficult is this? Well, put it this way: if you've never been in an American grocery store, a big supermarket, if you've never been in the produce section of a produce store, uh, and your assignment is suddenly to find three vegetables that are green, three vegetables that are not green, find five different things of fruit that are different colors. That might be a daunting task, but quite frankly, if you know your way around the produce section, um, you could do that in probably in less than 30 seconds. It is that easy, and that's how easy portfolio and risk management is. They write books about it. I don't know why. But here's how it works. Basically, this is how I look at it, and you may want to adjust it for your own self, is risk per stock. When you're buying a stock for a portfolio, probably looking at 1/4 to 1% of the total value of the portfolio. That's what you're risking initially. Okay. Now, why that big a spread? Well, that depends on how many stocks you can have in a portfolio. If you use the 1% criteria, understand that you may only get five stocks. You may only have enough room in your portfolio for five stocks that meet this 1% criteria. Um, and you'll see why in a moment. It might only be three or four stocks. We'll see. The uh, when it so the other part of the criteria that you need to look at is what percentage of your portfolio you're going to permit a certain sector to have. A sector might be something like utilities, telecommunication, consumer, discretionary, industrials, things like that. So you make a list of sectors, and if you need some help with that, just take a look at ETFs and notice the different sectors in ETFs, and you'll see the different categories they kind of cover. And so and one of the other things I'll do is a normal sector I'll allocate up to 20% of the total portfolio value of things that I think are hot. So right now, what's hot, for example? Well, let's take a look. What's hot right now, for example, is and has been for quite some time is are the what do we call those emerging markets? Here's Brazil, for example, and on pretty much a lot of my charts, you'll see a line like this, and all that is what I call an ORE line. That tells me a probable turn has occurred. And here's one. Here's the Thai fund, for example. That would be part of a hot sector right now. Here's BRF, Brazil, and this is small cap, and this is part of a hot sector. And and so I'll look to allocate up to 20% of my total capital in my portfolio for a hot sector. Okay, I maybe go a little more than that sometimes. Okay, so that's a hot sector. What else is a hot sector right now? Well, gold stocks. Okay, um, here was an ORE that we had in this gold stock over here, and then let's see. Here's another gold stock. Here's a gold stock down a little on the day. We had an ORE over here, and then I wound up buying some over here. This is a wonderful example of what happens here. On this day here, I wound up buying. Now, so how did I come to my to how many shares I bought? Okay, well, First of all, this is a hot stock because it's in the it's Anglo Eagle mines. If we can look at the this is a weekly chart, and you see just the maybe monthly would be better. Here we go. Monthly, we can see that the lows are pretty much higher for the last year or so, and so it's been going up. It's gold is a hot sector, so uh, okay, so wind up getting in over here. Okay, getting long on this day here, and what I determined was, first of all, the value of the stock is mid 60s in terms of dollars, and my risk was going to be about $3. How did I get to $3 risk as an estimate? Well, what I did was I wanted to have a risk of a stop close only. Now the problem with a stop close only, it's different than a regular value that you can easily measure. So what I do is I take a look at my wide swing days here, and I take a look at the average of them, and that came out to about $3, which is 5% of the value of the stock roughly, and uh, and so my risk was $3. And so if I'm going to risk $3 in a $100,000 portfolio, that would be $1,000 risk, right? And $1,000 risk, if with a price of $65 a share or $62 a share, whatever it was, maybe if it was under 60, uh, whatever it was down here, let's say this would have been 64 and some change, then that would mean I would be risking about 400. I'd be able to buy 400 shares. Now let me show you what happens with that huge number. 400 shares is a huge number in a 100,000 portfolio because it takes up $26,000 if you're buying 400 shares, right? And so that would effectively be 26% of a $100,000 portfolio. So in this case, we're in this contest here, this is in using margin, so it's really a 200,000 portfolio. So it kind of works out. Okay, so we've got that handled. Okay. Um, Now the other thing that I like to do is in order to be able to have more stock in my thing and have more oomph to it, is I like to let prices come down to a probable extreme, or come to a probable extreme, and then let them go up a little bit and let them come back down before I wound up getting in. And so that's why on this day here we had our other signals telling us to get in here. Now why would we do that, or would I do that? Well, because when I get over here, I have a signal. I've typically had a signal that tells me this is the end of the move, and I have several days in which to see this, or bars, or whatever, if I'm looking at intraday, bars to see this. And then in the those of you that have taken the expanded course, for example, there's a video in there that talks about uh, things to do to validate pivot 1. Now pivot number 1, and this is one that we made this year in 2011, and so you can validate what, when you're down here, and if this is a pivot 0, 1, 2, if you're validating pivot 1, there's certain lines you draw and you say, well, is this true, is that true, is that true, and if those things are true, then the probability is really good this is pivot 1. And so then you can simply open the manual, go to the golden pivot rule, and there and in our videos you'll see there's lots of good ways to know whether this is probably some kind of a pivot 2, okay, and whether this is a good place to get in the move and take a risk on the ride to the upside. All right, so that's the idea. Now, one of the things that Andrews had that others didn't was he had a way of getting in very, very close to the extreme. And as a result, if he was going to risk 1%, let's say, if he's entering the market here, he could buy 400 shares, but if he's entering the market up here, he might only be able to buy 100 shares, okay, in that 100,000 portfolio. So this is one of the benefits of using the Andrews techniques effectively. Okay. Let's see, what else do we got to cover here? Okay. Okay, so let's take some. Okay, now one of the things is that I've shown you an example. Let's show you another example. Another example was one I communicated yesterday, STD. Uh, Basically, here we had our probable reversal point. So we just drew something simple in here. It looks like a median line. And uh, okay, so prices went to our reversal point. They went up, they went down. We had weeks to find this, right? And so as they came down, wind up going through, gee, is this is a valid pivot one and stuff like that. And then prices came down and determined that it more than likely was. And so as they came in here, we were able to find a nice buying opportunity, and sent it out as saying, gee guys, I'm long here, and only to have a guy come back to me saying my son worked for them with a computer company and found that they look for 75% of their loans to go bad, and they calculate their business on that, and which is an interesting business model. Anyway, so apparently they make money on that in spite of that somehow. And so this is and this is a hot sector. This is a bank in South America predominantly, and it's been around for hundreds of years. So that's another example. Okay, but once again, the trick is getting in with a reasonable amount of risk dollar wise, and if you get in, the closer you are to your risk point, the better off you are because you can add more shares, or you can consistently have a lower percentage at risk. You can come much closer to the 1/4% or 0.5% at risk per trade and have a very, very diverse portfolio. Okay? And that's kind of neat to have a really, really diverse portfolio. The only thing is, even if you have a diverse portfolio, you have those nasty things called black swans. And we'll call them black swans. And basically what that is you have in the market you have sectors. So if you take a look at a chart, you'd see that gold started its upturn in the year 2000, and you'd see that uh, internet stocks, for example, started their downturn in 2000 or somewhere early 2000, and and so with our technology, you're able to take advantage of these different cycles in the different sectors. But very often what happens is black swans come at once to all sectors. And so how do you deal with that? Well, one of the things that you do is you keep an eye on the main indices. When you get the main indices, like here, for example, uh, this is over here is where all this bad stuff came out about Goldman Sachs and all that other stuff, and kind of an ABC. And this was a wonderful correction here, just incredible, a good 20% plus. And let's call this a black swan of sorts. And so with this black swan of sorts, you really should have been out over here and using our technology. If you simply look at the video, 7 reasons to take profits, which is available to the public, it gives you some idea. But if you take our course, you'll see that we have videos that one of them is 12 reasons to take profits that go into incredible detail and show you the techniques for determining that, hey, that in this area here, this is a weekly chart, uh, you had so many signals in here telling you this was the end of the move, that it was a good time to take profits. And typically what happens is that in these various sectors, you'll find that as you get towards the end of a cycle, like here, and where you're going to have a black swan event like this here, this nice big correction, then you'll be able to be out of the market and be in cash, ready and able to take on the next nice swing that goes to the upside. See, because one of the things that I like to do is I like to, whenever possible, take advantage of a third wave. Now I do that, actually I do a double third wave, and let me show you how it's done. If you, and it doesn't even have to be the third, if you look at gold, for example, let's look at STD. That was STD, easy one to remember. Okay, here's your weekly chart, and we can see this was a low, and so here maybe it's going into either a C wave upside correction or some kind of a third wave. Okay, there are several things using the course methods that would have told you, that would have alerted you to buy in this area here. There's absolutely no question looking at this chart. The thing is, we know that in addition to giving signals here, which you could find in my Precision Trader Yahoo group, you'll see that, which is free to the public, by the way, we also discussed it in this, as it was in this area here yesterday. And once again, you had some kind of an ABC, and then some kind of, right now I'm looking at this once again on a daily basis, at the very least, as being a third wave. And so I'm also looking at this as being a third wave on a weekly basis. So I effectively have some kind of and maybe even monthly. Okay, so double or triple third wave. And one of the things that really helps is being in third wave in most situations, or some kind of continuation, okay, versus trying to fight it by getting in when, here's a good example of trying to fight it. Prices have come down and they're still in their down move. Or it hasn't been a determination that they're in a probable up move yet, and then taking this to the ride to the upside. It just winds up taking a very, very long time. Notice the number of days it took to go up compared to the number of days it took to go down. The energy is obviously biased to the downside. Right? So this is what you want to look for. It's very easy. If you use the course methods effectively, it should be very, very easy. Let's see, we've gone, okay, we've done it all. We've really done it all in this quick thing on portfolio management, made very, very easy. And let's face it, if you can use this particular strategy with whatever you like. You can use this strategy with Forex. Okay, let me show you how it works with Forex. Now with Forex, you do something a little different. Okay, one of the things you're going to do different is with Forex, for example, you risk a maximum of 2% per trade of your total portfolio. You risk a maximum of, and that's if you're going to do a trade, one trade in a day. You look for one trade in a day. Sometimes you'll find two. And so if you find two, you risk a maximum of 1% on each one. And then at any given time, you might have a maximum of 4 or 5 positions in your portfolio. So if you're, let's say, risking less than, let's say, an average of 1% on each one on your initial risk, your initial risk is, from your initial entry point, is less than 4 or 5% of your total portfolio. Okay, and that's kind of neat. And so then you can use the course methods to get in and take it for a nice ride. And you can do that with a lot less intrepidation, a lot less fear, discomfort, or anything like that, by simply knowing that not only is probability with you, but you're risking a very small amount, an amount that you can afford to risk. Right? So, and then as you take, and then be sure, as prices go, and let's say if you go long down here and prices go up, or you go long here and prices go up, be sure to feel comfortable enough to, hey, time to cut some of the beautiful fruit off the trees. When you're taking profit, think of it as taking ripe fruit or close to ripe fruit off the tree. Okay, Think of it that way, and you'll be a lot more comfortable with taking profits. And then realize it might get a little riper if it stays on there, but you've got really good piece of fruit right there. All right. So I thank you for your time. Got questions? Support at andrewscourse.com. And if you get a chance, take a look at taking our course. Okay. See ya.